You're now watching episode 49 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, a CPA and managing partner at the Real Estate CPA. And today we're going to go over where to find your suspended passive losses on your tax return. So every tax return that you have over the past few years, if you have rental real estate producing a loss, you do have a special form in your tax returns that will show you exactly the amount of suspended passive losses that you are carrying forward from your rental real estate activities. Before we jump into that, I invite you to join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. And check out taxsmartinvestors.com. It's our membership site. We have content, other services, and private groups and things like that you can get involved in. We've got a big announcement coming out over the next couple of days. So go check that out. But follow us on that Facebook group as well. So before we jump into the form itself, I think it's important to explain to you why you should even care to know the amount of suspended passive losses that you have carrying forward year to year. And the best way to explain that to you is through the use of story. So we had a client that came to us, brand new client, and this was last year, came to us and said, "Hey, I'm in the middle of a 1031 exchange. I need you to help me calculate my cash boot from the 1031 exchange." Now, we're not going to go into cash boot and mortgage boot. That'll be another episode, another Tax Smart Daily episode in the future. But we started looking into his account. We started looking into his gain. He had about a $200,000 gain that he was rolling forward in a 1031 exchange. But what we also found by reviewing this specific form that we'll talk about in a second is that he had a $400,000 suspended passive loss that he was carrying forward from his prior years. So in prior years, he bought rental properties. They were all subject to the passive activity loss rules because he wasn't a real estate professional. He didn't have short-term rentals. He wasn't materially participating. So they were all passive activities, and they created passive losses. Well, those passive losses became suspended, and over time, they really built up into large amounts of suspended passive losses, about $400,000 worth of suspended passive losses. So when we found that, we took that to him and we said, "Hey, are you sure that you even want to do this 1031 exchange? Because you have $400,000 of suspended passive losses that the rental sale, 200K of gain, you'll tap into that 400,000 of suspended passive losses, and you'll still have about $200,000 of suspended passive losses that you can use going forward." So the suspended passive losses for this client gave him a cushion to decide on whether or not he should use a 1031 exchange and continue along with those suspended passive losses, or if he should just tap into the suspended passive losses now and start drawing them down by selling his real estate at large gains. He chose to sell his real estate at a large gain without going through the rigmarole of a 1031 exchange. Nothing against 1031 exchanges, but if you have large amounts of suspended passive losses sitting on your books, you might not need to do a 1031 exchange. You don't have to get creative. You can just sell your property outright. So it provides you with a cushion to make those types of decisions. Now I want to show you how you find out where your suspended passive losses are and what amount you're looking at. So I'm going to share my screen, and this is the form that I've been talking about. So this is form 8582. If you have rental activities or passive activities that have losses, you will see this form in your tax return. And if you're not sure where this form is in your tax return, I know that people have 200-page tax returns. You can hit Control F and then type 8582. Hit enter a few times, and you will eventually find this form. This is the passive activity loss limitation form. And what it's going to show you is your losses and income from all of your passive activities in years that you have like losses and things like that. So first, in the first section, we have rental real estate with active participation. So this is not like if I invest in a syndication as a limited partner. If I invest in a syndication as a limited partner, I'll be down here at all other passive activities. So if I own my own rental real estate and I have active participation, not material participation, just active participation, then I will sum it all right here. So this is the sum of all my Schedule E entries, and we'll go over those here in a second, but it's all on form 8582, which is really cool. all other passive activities. So I've always said, if you have passive income from one activity, the passive losses from another activity can offset that passive income. So you'll see down here, we have an entry here. We don't know what that is yet, and we'll go over that. But the point is that we have passive income from some activity, and we also have rental losses that are offsetting this passive income. So we'll talk about that netting effect here in a second. All right. So in box 1A, we have activities with net income. So if you go to Schedule E and you see, oh, I've got a $2,500, I've got a rental property that's producing $2,500 of net rental income, you will ultimately see that reported here as well. If I go to line B here, that's net losses. So now I have another rental activity. Maybe it's a bonus depreciation year and it's showing $45,000 net losses, or I have multiple rental activities showing net losses on my Schedule E, and the sum of those are $45,000. And then I have prior year unallowed losses. All right, so this is a big one, 1C. So everybody should always, if you are a landlord, you should always 1000% of the time, I don't care who your CPA is, I don't care if we're your CPA, you should go to Form 8582 every single year, and you should look at line 1C to make sure that your unallowed losses from last year were appropriately carried forward. So this $8,000 is coming from last year's Form 8582. Really, really critical to make sure that you get that right. We have seen CPAs not carry this forward, sometimes to the tune of hundreds of thousands of dollars. And the bad thing is that clients don't know, because if you just have activities that produce passive losses on an ongoing basis, you're not going to know that somebody has messed up carrying your losses forward until you eventually sell the rental property, a decade down the line. And then even at that point, you might not connect the dots. So really important to make sure that your suspended passive losses are being carried forward every year. If there's one thing that you check on your tax returns every single year, if you only have if you only have time for one thing, this is what I want you to check. Form 8582, 1C, 3C. Those are the two boxes that carry forward prior unallowed losses. You do not want to miss those. Trust me, you do not want to miss those. All right, so what 1D is here, it's a netting effect. So we're just adding all of these together. So you got $2,500 minus $45,000 minus $8,000, and we get a loss of $50,500. So we have a net loss with all of our rental activities of $50,500. Now we get down to all of our other passive activities. We have net income here. We don't have activities with net loss, and we don't have prior year unallowed losses. So we just have net income in this section, and we have $6,500 of net income in this section. Now, line 4 here says combine lines 1D, 2C, 3D. So if your CPA ever tells you, hey, your business, this business investment that you made that you're passive in, it doesn't actually net out against your rental losses, this is exactly where you go to tell them, hey, I don't think that you're right, because if I'm passively involved in a business, it's going to show up right here, and then it's going to show up right here, and it's literally going to net out against my rental losses, and it's going to be on line 4. So it nets out. Your rental losses are passive. They net out against any other passive income. So if you have passive business income, whatever, it will net out against rental losses. Okay, so part 1 encompasses all of this that we just talked about. And this is going to show you at the end of the day how everything nets together. But if you're crunched on time, the one thing that you need to look at, I know I just told you to look at 1C and 3C, but really it's line 4. It's line 4 here. The negative $44,000 loss. That's going to be your suspended passive loss in most cases. Sometimes it's not, though, and I'll show you why here in a second. So if we continue scrolling down, part 2 is the special activity loss allowance. What is that? That's the $25,000 loss allowance for passive activities where you actively participate. So if your income is above 150, which in this case it is, because line 7 says 250, then your passive activity loss allowance is $0, because once you get above 150, it's totally phased out. So in this case, we're not concerned about it. We're just moving on. And then you get down to total losses allowed. We have $9,000 total losses allowed. Now, how is that? Well, we're adding 1A and 3A together. So let's scroll back up and look at 1A and 3A. 1A was $2,500, 3A was $6,500. So we were able to use $9,000 of passive losses. Now let's go take a look at what makes up all of these activities. So we just talked about 1A, 1B, 1C, 3A. Well, we're getting those numbers from somewhere. The cool thing about Form 8582, and this is why I love this form, it's the number one form that every single landlord should know and get used to seeing and get used to looking at, because it summarizes everything for you. So if we scroll down, they always come with these worksheets, these 2 pages of worksheets. Now, worksheet 1 is for the rental real estate activity section. So if we scroll back up, we're talking about the rental real estate activity section, right? So look at this. We have 2,500, 4,500, and 8,000. That matches 2,500, 45,000, and 8,000 as well. All right. So 1 Royal Drive, King Landing. This is Jon Snow, remember? So Jon Snow owns a rental property in King Landing. He's got net income of $2,500, and he has a prior unallowed loss of $8,000. So that's where that unallowed loss was coming from prior years. It was from this rental property. So he's got a total loss of $5,500. Then we also have Ocean View Castle Rock. Maybe that's a vacation rental, or at least one with an ocean view. I know that Castle Rock looked pretty cool in the show. It's got net losses of $45,000 this year, and so it's got a total loss of $45,000. Now, if we scroll down, we see, oh, there we go. We've got Castle Black Laundry. So Jon Snow is an entrepreneur. He's over there at Castle Black, and he is running the laundry, and he's making some good money from those coin operated machines. So $6,500 of net income. He's got that gain of $6,500. That's worksheet 3. That's reporting the other passive activity section. So now we get down to worksheet 5 and 6, and this is where the real magic happens. So what we're doing here is we're reporting our rentals or any passive activity that has losses, right? So what we're going to do is we're going to assign a ratio to it, and then we're going to allocate the remaining losses to these activities. Now, you don't exactly need to know how all of this works. That's less important than the big takeaway of where to find your total unallowed losses that you're carrying forward. But this is somewhat important, because it's going to show you the unallowed losses that each activity is reporting. So if we get a total of $44,000 unallowed loss, how is that actually broken up per activity? And this is what is happening on worksheet 5 and on worksheet 6. Now, on worksheet 6, this is really where the magic is. So I know that I said, you can look at line 4 here on form 8582. And typically that's going to be the correct amount of suspended passive losses that you're carrying forward. But sometimes it's not, because sometimes the way that these ratios work out is that this amount is the amount that is actually, this amount is the true amount. This is always the true amount. So this worksheet 6, column B, the total, that's always the true amount of suspended passive losses that you're carrying forward. Sometimes we have seen it be a little bit different than what's here on line 4. So just be aware of that. So if you want to know the suspended passive losses that you're carrying forward to next year, you go find form 8582. You can look at this detail. I highly recommend that you look at this detail. Make sure the unallowed losses are being carried forward appropriately. That's 1C and 3C. But then line 4, that's going to be where you're looking. And if you really want the source of truth, it's worksheet 6. If you control F, you'll still find 8582, because look, it's got 8582 right there. But worksheet 6, unallowed losses total $44,000. That's what Jon Snow is carrying forward into next year. And so any passive activity that generates income will be able to tap into this $44,000. So really important to know, because you can make selling decisions. Maybe you're in a hot market like we are right now, and you say, hey, I want to sell my rental property. Do I do a 1031 exchange, or do I just eat up these unallowed losses that I've been carrying forward? Or maybe you want to invest in a new business venture, and it's going to be a passive activity for you. And you're thinking, oh gosh, man, I'm going to create passive income, and that passive income is going to be taxed. Then you go, wait a second. I remembered this episode on the Tax Smart Daily that showed me where to go check my unallowed losses. You come here and you go, whoa, I have $44,000 of unallowed losses. That means I'm not going to pay tax on my business income from my coin operated laundry for like 10 years. So I'm good with that, right? That all of a sudden becomes a much better investment after tax for me. And it's a sweet netting effect, right? Like, this is the holy grail of just netting everything out from a tax perspective. It's not ideal to create a ton of unallowed losses that carry forward every year. What is ideal is to have businesses that generate passive income and businesses that generate passive losses, not net operating losses, but passive losses for tax purposes, like rental properties do. And then those passive losses offset the passive income from the businesses that you're investing in. and you don't pay tax. So you generate all of this tax-free operating income, awesome cash flow. That's the way to do it. That's how our most successful clients do it. They start in rental real estate and then they start going, wait a second, I have these large amounts of unallowed losses. How do I start offsetting that? I'm going to buy stakes in businesses. I'm going to take an equity stake in these businesses. These are not going to be corporations unless it's an S corporation. And those businesses are going to pass income back to me. I'm not going to materially participate. So it's going to be a passive activity. The passive income offsets my suspended passive losses. I don't pay tax until those suspended passive losses are totally eaten up. So thanks so much for watching today's episode of the Tax Smart Daily. I hope that you found it useful. Check out all the links in the description below. We've got a great social media presence and really invite you to join that Tax Smart Facebook group. We've got a big announcement coming later this week. And we're only going to announce it in that Facebook group. So check that out. And if you have any questions or if anything that I said resonates with you, drop me a comment below. I love engaging with the community. It's you folks that take 10 to 30 seconds out of your day to drop me a line that keep me coming back to the table.